Okay, week 3, last one. Today, we'll go over market conditions, part 2, price gaps, inefficiencies, and imbalance, and Fibonacci. So, something simple, right? First, we learned market conditions part 1, where we learned a bullish trend, a bearish trend, a consolidation trend, right? And break-off structures. And by now, you should know that what are pullback and retracements. So this is something I've just quickly mentioned. On a bullish trend, when you see price pullback, right, move, retrace the opposite way in a bearish trend, in a bearish move, that is a retracement, a pullback. Vice versa, with a bearish trend, when you see a opposite move happen, where price moves bullish for a short time to create a new lower high in this case, that there is a pullback or a retracement. Yeah. And pullback and retracements are important for us to actually identify trade opportunities. That's something we'll look into deeper in the course. But this is what we call a complex pullback / retracement. So all we have seen till now is a perfect bullish trend, a bearish trend, and a consolidation trend, where my price perfectly keeps moving upwards or downwards, right? Like, for example, we always think of price moving with a higher high, a new higher lows, right? But there are instances where price may confuse you a bit. So price can do something such as create this new higher high there, and then give you a new lower high, which is right there, create a new lower high. And right here, a lot of traders in the market and early sellers in the market get confused and start taking in new positions at this lower high. But if you do notice structure-wise, price would usually do something like come towards the last higher low, creating a new low, and then taking out all those early sellers in the market, all those new traders right there who had the stop losses around there, and again move bullish. The main thing here when you're understanding complex pullbacks is to understand structure itself. On a bearish trend, look at the low, right? But on a bullish trend, look at the low. On a bearish trend, look at the high, right? So over here, let me also adjust this one. So on a bearish trend, this trend, it could make a new high. Wait, let me delete this chart. Hold on. So let's look at a bearish trend, right? So we have a bearish trend creating new lower highs, new lower lows, right? And price may do something as create a new high, right? And take off these lows. Sorry, my bad. Give you a lower high, hold this area there, and create some structure where you get confuses all the sellers, all the buyers in the market, right? Like if you look at this one, it creates a lower high, creates a new higher low, and pushes up back to the area of high, right? The same area. So when you're looking at the bullish structure, you look at the lows of the structure, right? But when you're looking at this bearish trend, you look at the high of the structure. So here, right? So it creates a new higher low right there. But this is where the new buyers in the market get confused and they start entering the market early, the early buyers. But if you notice structure, it doesn't take off the highs. It again drops. So in this sense, it takes off all the early buyers in the market, takes off all the stop losses and drops. Because what happens here, the high here stays intact. But this new higher low actually confuses all the buyers, right? And they start taking long positions at this area. So in a bullish trend, you look at the higher low. On a bearish trend, you look at the lower high, right? Because if you notice structure, it never breaks. It just confuses a lot of people and then drops. This is a complex pullback. This tends to happen in the market because the market isn't perfectly perfect, right? It tends to happen and we end up seeing a lot of liquidity getting grabbed around these areas. So I think I have an example here. Hold on. So this example here, yep, you see how we have lower low, a high, a higher low, a higher high, a higher low, a higher high, right? And this example is even more interesting because we have two complex pullbacks here, right? So we see a low, right? A new low been created, which is the same as the previous low. So this is a low. We see a lower high. So this lower high starts confusing a lot of sellers in the market. And sellers start entering this position. And it drops back to the same low, right? Still keeping the structure intact. And then we see another push, right? Again to the same high, right? A lower high gets created, again confusing the sellers, but eventually you see how price breaks through above, creating a higher high. So this shows you that a market is going to confuse you a bit. You need to look at the market in a broader spectrum, look at the structure perfectly, right? So in this, the structure isn't broken; it is intact, right? Because the lows in this, the higher low never gets broken through. Only if this higher low here breaks is when we start looking for a break of structure and we start to see a second leg and a third leg, right? Till that happens, the higher low, the structure remains intact. So if I wanted to see a true break of structure here on a bullish trend, so we see a bullish trend, we see a push, we see another actually, why did I move this? Hold on. So we see a lower high right there. This here confuses a lot of the sellers, but if you look at structure wise, price doesn't truly break through, right? The last higher low, which is right right there, right? This high low never truly breaks. Once that happens, we see sellers come through, but then the buyers push out all the early sellers in the market. So structure remains intact. It's extremely simple. It's just a new lower high confuses people in the bullish structure. In a bearish structure, a new higher low confuses the people, right? So that's your complex pullbacks, yeah. So a very important concept that you got to learn, right? This is price gaps. We also call this as inefficiency or imbalance. So the market has to move efficiently all the time, right? Usually, and the reason for that is it needs to give both the buyers and the sellers opportunity to enter the market. So when market has a lot of high volume and price shoots up or shoots down, due to this, there is a gap created in the market or an imbalance, right? So price has to eventually, over time, come back to that area where that imbalance is to fill up the gap, to give buyers and sellers an equal chance to enter and exit the market. Because at the end, the market is a zero-sum game. For every buyer, there has to be a seller. For every seller, there has to be a buyer. So if market moves too aggressively, this doesn't give a lot of buyers or sellers certain opportunities to exit or enter the market. So understanding these gaps, these areas, can help you with a directional bias on where price can move to, and can help you understand where market may retest to enter, or even setting your take profit at these areas. And this is something we'll go very deep into the SMC section, yeah? But for now, I want you to understand what exactly price gaps are. So example number one, this right here on example number one, this is an efficient price action. There is no gap. So if you notice candle number one and candle number three, if you notice the wicks of those candles, they are perfectly aligned, they meet, right? If you had to draw a line across it, you'll see that the wicks meet, right? And this shows you that this is an efficient price action, giving both the sellers and buyers certain equal opportunity, right, to enter and exit the market. But in example number two, if you notice candle number one and candle number three, those candles wicks do not meet each other, right? Because of the candle number two, which had heavy volume and it pushed price down way down. This here is a price gap. Therefore, in time, price has to eventually come back to candle number one's wick, meet it, and fulfill the gap that was left in the market. And this is inefficient. This is inefficient price action. So let's look at a few examples first. So let's open up let's look at Euro USD itself, yeah? So let's look at this in a broader spectrum here. Okay, there's a good example here actually. So notice this candle here. Actually, not even this candle. Notice this candle here and candle number 3 here, right? If you notice the wicks of these both candles, they do not meet each other, right? If I had to draw a line across the wick of this candle, you notice how the wicks don't meet each other, and this is a price gap in the market. This whole area right there, this whole area there is a price gap. Therefore, over time, price has to eventually come towards the wick of this candle here and fulfill that price gap. Look at what happens to price in time, right? If you have to move that area there, you see how it comes back in time eventually and fills out that area there. That wick fills out that inefficiency that was created there. And you notice once that happens, price gives us a push, right? So that there fulfills all the gaps in the market, giving all the buyers and sellers an equal opportunity to enter and exit the market. Another example, let's look at. Let's look at a. So we have another one here, right? So we have wick number 1, wick number 2. They don't perfectly meet each other here. So if I had to draw a line there, right there, yeah, you notice how there is a gap in the market there between these two wicks. So let me draw out a rectangle area there. You see how we have a gap here, right? There's a gap in the market that has not been fulfilled. So if I had to stretch out the area here towards the right, and you'll notice over time, price came here, gave us a fill, right? It filled out that gap. And then we saw some form of reactions happen at this area, right? So this is something will be very useful when looking at break and retest strategy, the patterns in the market. So again, let's look at another one. Okay, let's look at an efficient price action, right? So if you look at the wick number 1 and wick number 2, you see how they perfectly conjoin, right? Conjoin between each other. They're perfectly meeting each other. That right there is efficient price action. Price hasn't left a gap in the market. But if you look at another example, for example, let's see, this one, right? Wick number 1, wick number 2. The gap created here is a price gap right there, right? And if you look towards the left, if I had to draw a horizontal line, you see how price eventually comes back towards this area to fill out that wick, which was created, the price gap. So if you understand this concept here, you can understand that why price reacts and retraces the way it does, and which areas would be high probability, and even when you're analyzing which areas can price potentially be attracted to. These price gaps in a way act as a magnet, right? They're a magnet, and eventually price has to come back to it. Yeah. So someone mentions that, is it all the time the price does have to come? Yes, it doesn't have to come back immediately. It doesn't even have to come back for a few weeks, right? So let me give you a good example here. Let's look at maybe BTC, right? Bitcoin. Let's look at a Binance chart, and let's look at price gaps on the weekly time frame, right? So let me delete this here. Okay. So let's look at the look towards the left here, and look at the price gaps, right? So that's gap 1, gap number 2, right? And this was created in 2020 of November, right? And if I have draw a horizontal box here to figure out the price gaps, you'll notice what happens is price eventually comes back here, and that happens only on 2022, almost after 2 years. So price has to eventually come back to those price gaps and fill out, but the time it takes to come and fill out those price gaps is unknown, right? Especially in these higher time frames, on the weekly, on the monthly, or even on the daily, right? It's unknown. But if you do know, if you can figure out those price gaps and you are smart you were smart, you had probably some positions around those areas there, you could have probably capitalized on it really well. Yeah. So here on BTC, we still have a price gap all the way down here, which has yet to be met, which is at this area here, which is at this. So we see a price gap around this area at 12,000. It's a price gap that price has to eventually come in and fill, right? So those price gap tells me that maybe I should wait and see if price can actually come there for me to buy Bitcoin, because me buying a Bitcoin here wouldn't be the most efficient thing, right? Because the difference between this point here and that price gap there is a gap of 61%. That's big, right? So price gap is something you have to figure to understand to really apply it to the SMC section. So once you understand price gap, we will start looking at how to draw out supply demand zones, so we can take certain break and retest entries. And price gap provide us a lot of ample opportunity. And price gaps, if you look at the theory of price gap itself, why do price gaps happen? It's because of volume, right? And this heavy volume indicates those areas where the price gap had occurred is a desirable area, a desirable price, where buyers or sellers favor to buy or sell, right? So very important. That's what I mentioned here in the note down below. We will dive in deeper into this in the SMC section. But for now, understand the concept, yeah? So let's look at Fibonacci. So Fibonacci, this slide right here is something I've put in just for basic info. Don't get stressed by all this information. So Fibonacci is a numbers, right? Fibonacci numbers are sequences of numbers where each number is the sum of two preceding ones. So if you start from 0 and 1, the sequence follows such as this, right? 0, 1, 1, 2, 3, 5, 8. These are Fibonacci numbers and so on. And this sequence here has many interesting properties and applications in mathematics, nature, or computer science. So the Fibonacci sequence often is found in nature, and it applies to things such as the patterns of various species of plants, the way those leaves grow on the plants, right? Animals, sea creatures, like here I mentioned the arrangement of leaves and branches on a stem, the number of petals on a flower, right? If you actually pay attention to these, the Fibonacci numbers are perfectly present in nature, right? So just cause this is present in nature, the psychology of Fibonacci actually trickles down even into the market. So so the Fibonacci sequence is also, we mentioned it as golden ratio, a nickname, a term, and it's usually occurs everywhere, right? Mathematical pattern in the universe. This equation here is a Fibonacci equation. Don't need to get confused with that. That's for just for your information. So Fibonacci. So before we go into that, let me show you a Fibonacci retracement tool. So if you don't know, a Fibonacci retracement tool is on the left. If you, that right there, Fib retracement. So that's the tool I'm using. You can, if you double click here and the style, these are the Fibonacci numbers that I look at. But this is my older settings. But the newer settings with the SMC section is something we'll get into deeper later. But this numbers right here, this Fibonacci sequence numbers is what is used by the majority of traders in the market. So the number 0, the 38.2%, right? The 12.4%, the 23.6%, the 50%, the 61.8, 78.6, and 100. These settings are the most frequently used Fibonacci settings in the market, right? And so I have put on those settings right here on the slide or on the notes. If you want to copy those settings later, you can do so. So the Fibonacci retracement tool is where price, what it measures for us as traders is where price can potentially retrace to, and see where the third leg can be created on our 3-leg extension, right? Can only be used on trending structure, very something to keep an eye on. It can only be used, Fibonacci tool can only be used on a trending structure. It cannot be used in a consolidation. It can only be used in a bullish or a bearish trend. And a lot of traders also actually like to mark off their supply demand levels using Fibonacci. They like to enter trades using Fibonacci, setting their take profits or even points of reversals. These are some things that I'll show you, but these are some concepts that I don't personally use, but I want to give this information to you, so possibly it could be beneficial to you, right? So let's look at Fibonacci here and how to draw them out. So I have a slide here before I show it to you. Hold on. Where is it? Yep, right there. So Fibonacci, to draw your Fibonacci tool, you need two areas, right, on a trending structure. So if you notice my left photo right there, or bullish trend, we see point A, you see your point B, and then you see your point C. You'll notice that the point A is at 100%, point B is at 0%, and point C is with the retracement that we are gauging on. It happens at 50%, and then we see price move again bullish, right? So we are trying to look at the retracement with Fibonacci. That's the main goal here, right? So a lot of traders actually get confused with how to draw your Fibonacci. So on a bullish trend, right? Let's take an example here. So if, let's say I wanted to measure this retracement that occurs here, this wick, right? We see a bullish move, then we see a retracement, then we see a push. So I want to measure this area right there. All I do is, let me delete this, get my Fibonacci tool out, pick point A, point B, and then I see point C, which occurs at 61.8, right? So point A, point B, and then point C. And a lot of traders who trade the Fibonacci are probably taking trades around this area here, and then you see price pushes bullish, right? Again, let me show you another example on a bullish trend. So let's look at another pair here. Let's look at GU, right? Let's look at GU right here, right? So let's look at GU. So we have your point A, and say I want to see this retracement there, point B, which is right there. And I noticed the retracement is quite shallow, right? It's an extremely strong trend. So that's point A, that's your point B. And then you see a point C occur at 23.6, right? And we see a push. But traders in the market usually like to take their trades at this entry zone here. So before I actually show you a few more examples, look at it. Let's see. So your 38.2, your 50%, and your 61.8%, those Fibonacci levels are your highest probable areas if you're using the Fibonacci ratios, right? These are your entry levels. These are the levels where traders entered the market, and the negative Fib levels, the negative 23.6, the negative 61.8, those are the levels where traders exit from the trade. So they enter the trades around here at this Fib levels, and they exit the trades at these levels up here, the negative, right? I've also mentioned in SMC section, we look at different Fibonacci settings, right? But this setting that I've shown you, these settings are usually the most frequently used settings in the market, yeah? The most used Fibonacci ratios. So let me delete it here. Let me give you a few more examples and show you how Fibonacci actually works every single time. Let's see. Okay, let's look at the bearish trend. So say I want to measure the trend in this area here, right? This retracement is what I want to see, right? So I want to see leg 1, leg 2, and I want to catch the leg 3 that occurs here. If I had to draw my Fibonacci here, you see point A right there, point B right there. So let's stretch it out towards the right, point B. And then you see the point C occurs at that 50 and 61.8 area, which is a very high probable area for a lot of traders, right? So you see that. So you have point A, your point B, the low, the high, the low, and then the third leg, the second leg. So we're trying to catch the third leg. So we get a confirmation. And you notice the candles also at this area here. You see how they're starting to reject. And you see eventually we see a bearish volume come in, breaking these lows. So a lot of traders would like to use this area there, 61.8, 50, or 38.2 to take their entries. But they like to exit their areas at negative fib levels, which is at, also let me highlight that all. So if I was a trader who's taking a trade right there, I would be exiting my trade right there or right there, right? And you see how perfectly the trade flows through to those negative fib levels, right? So let me give you another example. So let's look at okay, so let's look at a bullish one. So we see I want to catch the trend. So imagine I'm looking at the chart right here, right? And this is where price is at. So I want to see where price actually retraces, and I want to catch the third leg towards the top. So I'll take my Fibonacci tool, that's point A, the low, the high, the point B right there. And then I see point C occur at the 61.8 and it retraces a bit too much at the 78.6. So a lot of traders would still take this trade, but the most optimal area would be for price to retrace towards 38.2, 50, or 61.8. This is where you have your higher probable chance of a push, right? Think of Fibonacci as your as a slingshot, right? If you see price actually retrace all the way through here, it isn't the best, right? But if it retraces towards these levels here, or in fact even this level here, that shows you the price is extremely bullish. People, the buyers do not want to stop pushing, right? So let me give you another one. The example. One second. Okay, so we have a bearish trend, right? I see price push breaking all these lows here. So if I was a trader taking off all the concepts that we learned together, I notice a few things happen here, right? I see price break the low here, switching trend, also leaving a price gap because we have 2 wicks right there, which are not meeting each other. I have 2 confluences there. And if I was using the Fibonacci, now I want to catch that retest. So number 1, number 2, point B down there, low. And if you notice price, what it does, it actually retraces, almost doesn't fill out the wick yet, right? But eventually fills out the wick right there. And that's when you possibly could take short positions from. These Fibonacci traders who took trades from 61.8 are probably early sellers, but you do see they still caught a small move, right? But the most optimal thing would be to catch it at the negative fib levels, which occur. I'm not sure why this switches off, but right there, right at the low, at these areas. So that's what Fibonacci traders are looking at. They look at these golden ratio levels at 38.2, 50, 61.8, your entry levels, and they're looking to exit out of the trade at the negative level at 23.6 or your negative 61.8. Yeah. Fibonacci, if you make it be, it can get extremely complicated. In my opinion, and all my years of trading, I did use Fibonacci, these exact settings, but I personally do not use it anymore because supply demand gives you all the answers that you need pretty much. But Fibonacci has helped a lot of other students that have taught, and maybe it may help you, right? That's the main reason why I'm going over the concept. So another way to look at Fibonacci is this, right? So the Fibonacci, what does it actually test or we gauge on? We gauge the retracement, right? And not only we're gauging the retracement, we're trying to gauge the retracement in a way to see the strength of the trade, like I mentioned. So if price in this way, we had a point, let me actually show it on my chart itself. So say this is our Fibonacci, right? And we see this is point A on a bullish trend, our point B, and then say we had a point C at the 50%, or let's say 61.8%, right? And then we see a push. The trend is always valid till these lows, the point A is broken, right? So if price had retraced all the way towards 100% right there, that would be still a valid bullish trend till these lows are broken. But this tells me the trend may be weak, right? Because price had retraced all the way towards the 100% area, right? But if price retraced towards the 78.6, this would tell me it's a weak trend because it retraced here, right? So these levels, the stronger it retraces, the lower, the shallower the retracement, the stronger the trend. So in this example, if price had retraced at 61.8, that is a bit of a steeper retracement, but it's strong enough because it's closer to that 50%. And for 50%, if price actually retraces there, that tells us it's a balanced trend. It's a balanced retracement, not a strong trend, not a weak trend, a balanced trend. And that tells us this is a balanced trend. If price had retraced to 38.2, that would tell me it is balanced, but it is a bit more stronger. 23.6 or at the 12.4, the trend is extremely strong, right? So that's what we like to, usually Fibonacci traders like to see price come towards that balanced area between that 50, 38.2 and 61.8 to eventually take a trade from and then exit the trade at these negative Fib ratios, right? So that this is what I have mentioned here, yeah? Just for an example. So how strong the trend is. All right, so for this class, we are done. Short class, but a very heavy one, very important concepts to learn, right? So let's stop our recording.